Good evening, everyone. My name is Derek van Rensburg, and Michael Saris asked me to step in just to do a brief introduction to Nick Dennis. You are all obviously clients of Anchor Capital and have certainly got a vested interest in the fund. So Nick has stepped out of his busy schedule just to give you some feedback of that are taking place in the market. So thank you all very much for your time this morning. It's very appreciated. I'm sure there will be some more people log on as we move through the course of the meeting. So just to quickly, briefly introduce Nick Dennis. Nick Dennis has since March 2015. That's when the fund was actually launched and has obviously sat behind the wheel, kind of navigating good markets, very choppy markets. And certainly as we've moved through the course of 2022, it's been a very tumultuous time as we've seen a lot of unwind happen, particularly in that tech sector, but definitely from an index level, fighting high levels of inflation and obviously higher interest rate environments. It has been quite a choppy market and quite a difficult market. Nick will go investment manager in the emerging markets team at Pictet. That was based in London. And he obviously then joined Anchor thereafter and has been with the team, I would say, just or close on about 8 years as we sit today. The fund has certainly been one of our flagship funds, and Nick has certainly got a very unique style in terms of his strategy and how he looks for opportunities across the global arena. The fund won a Raging Bull Award in 2020, where we got very strong performance. And again, sorry guys, if you unmuted, can I please just ask you to mute? And then obviously we can open it up where we unmute for questions at the back end of the presentation. So I don't want to take up too much time in terms of the introduction. I think at this point, I'd like to hand over to Nick. He's probably going to give you a little bit further detail in terms of introducing himself, and then we can obviously go through the nuts and bolts of the presentation. So I think on that note, if I can hand over to you, Nick.
Thanks, Derek. Can you hear me okay? And can you see my slides?
We can hear you, and your slides are up on the screen.
Okay. Good morning, everyone. So I'm going to give an introduction to the fund. I'm going to talk about what I'm seeing in the market today. That's also going to include where I see areas of opportunity in the market. And then I'm going to talk a bit about how the fund has evolved and how it will continue to evolve. So I won't rehash what Derek has already said, but the fund has a good long-term track record and it's won 2 Raging Bull Awards. Really what the fund is focused on, and I guess a point of difference versus other funds is I'm looking for multi-baggers. So those are stocks and companies with the potential to grow their revenue or cash flows multiple times because they're growing, because they're growth companies typically, and they've got an innovative product. And you think of names like a Tesla or a Tencent over time, and Amazon, Netflix, that kind of thing. So that's the ideal. It isn't always easy to find them. So to the extent that the fund doesn't hold those, I'd like to hold your classic kind of quality companies with a high return on invested capital. They might be more mature, but they are high quality companies. So you can think of like a Visa or a MasterCard, something like that. It's important to say, I can spell out what the fund is, but it's also important to say what the fund is not. So this is not a general equity fund. It is not intended to, even though it's got a benchmark, but it's not intended to mirror that benchmark. And it's not intended as a kind of a tracker or for any kind of style or market or theme or factor exposure. For better or worse, it's gonna do what it's gonna do, and it's also not a proxy for another fund, even though at various points in time it'll have overlapping positions with other funds, which is inevitable if you're running you're running a public fund. So long term, my goal is to deliver benchmark beating returns, market beating returns, and hopefully significantly market beating returns over horizons in excess of 5 years. What I'm at pains to say to people, please don't invest in the fund if you have a horizon that is shorter than 5 years. Because people will end up, inevitably, they'll come in after a period of strong performance, and then they'll sell out after a period of weak performance. I'd like to avoid that as much as possible. So, and I put that on the fact sheet that it's not recommended for people, investors with a time horizon that's less than 5 years. When I launched the fund in March 2015, my goal was to be in the top decile of global equity funds, or funds within the category. That's the top 10%. The fund is just over 8 years old, and I think it's on track to achieve that in the next 2 years. So I think there's a good chance that we'll reach that goal. And then, as I look into the next 10 years, I want to achieve that same goal. So to be in the top decile of global equity funds. And what that means is if you can achieve that sequentially, so back to back, the first 10 years and then the next 10 years, I estimate that will put the fund within the top 1% of funds since inception, and maybe even the top 0.5% of funds since inception, which to my mind would be a remarkable achievement. And that only accounts for funds that are still around in that time. And over that period, a number of funds will have gone out of business or will have hit the wall. So the real percentage in terms of like where it is relative to all other funds would even be higher than that. And then I think it's really worth pointing out that I've got serious skin in the game in investing in the fund. So my family is the biggest single investor in the fund, and that is by an order of magnitude. It's not marginal. It's not close. So when the fund goes up, like we experience that, and when the fund goes down, literally nobody experiences that more than we do. So moving on to the market, and these are just my observations. I'm not making a call on the market. But if you're like me, if you go on social media, if you go on YouTube or Twitter, or if you watch CNBC or Bloomberg, you will see a lot of negative headlines. There's a lot of people calling for the next recession and the next market crash. And this is just an extract from our YouTube feed. This channel keeps coming up, and it's all about recession and how debt is going to cause the market to collapse. It goes on and on. This sentiment is not just confined to kind of a retail audience. The professional investor audience is also pessimistic. So this chart comes from the May Bank of America Fund Manager Survey. And they look at various measures of sentiment, and I participate in the survey too. And what this chart just shows is that sentiment is at levels approaching previous troughs, and usually at extremes. The sentiment indicators are a contrarian indicator. So when everyone is very bearish, that's usually a bullish sign for prospective returns. When people are extremely bullish, then that can be typically then what happens next is like the market will underperform or will often come down. So that sentiment is reflected in their positioning. So investors are overweight bonds, they're overweight cash, and even within the equity space, they're overweight the more defensive areas of the market, so areas like staples and utilities and healthcare. And they have been underweight. What's quite interesting is underweight the US market. So they've been more bullish on Europe and other parts of Asia. And until now, until a few months ago, they'd been underweight tech, but this survey is about a month old, so I think that could have changed quite dramatically. But in general, positioning has been very, very cautious. And this is reflected in other surveys. So it's not just a Bank of America survey. So in this poll conducted by CNBC, more investors felt that the market was more likely to fall than to rise. What gets these kind of surveys to change? Well, it's a rising market. So people flip their opinions as the market goes higher. We tend to be pro-cyclical. Another way that I look at, I also look at other measures of investor positioning. So I won't go into the nuts and bolts of what this chart is saying, but the top line, the white line, is a measure of investor positioning in S&P 500 futures, and typically when it gets, and this is by speculators, when they get really depressed and really short the market, which is what you can see in the yellow circles, that typically coincides roughly, not exactly, but sort of roughly with bottoms in the market, or precedes periods of strength in the market. So in aggregate, speculators are fairly short the market. And so what this means, if you put it together as well, if everyone is already bearish or pessimistic, if they've already sold, if they're already short the market, if they're already positioned defensively, then even if the things that they fear, like a recession, an economic slowdown, even if that happens, there's probably I won't say no one left to sell, but your downside would logically be more limited. And for it to be worse than that, then the economic outcome would have to be way worse than people are expecting. But largely, people are positioned for a negative outcome already, so it's hard to be incrementally bearish from here. That's more in a medium-term kind of horizon. I mean, that said, and there is a proviso coming in. I think with part of that defensive positioning, investors have sought exposure to the market in the large cap or the mega cap tech space, and I think the sort of the hype around AI has really accelerated that. So people are crowding out of or dumping a lot of the other things and crowding into the mega cap tech names. And so what these charts show are inflows into tech, and you can see that the monthly flows on the left and some of the weekly inflows on the right are at a record. Quite often this can be a contrarian indicator. So when everyone's piling in, that's sort of just raise the antenna a bit. It's not necessarily a sign of an imminent top, but there are, and I'll show you some other charts later, but there are some signs that indicate some caution in the tech space. So I'm moving on to current opportunities, at least what I'm seeing. And to summarize it sort of fairly broadly, I think the areas with worse odds are, as I've said, I think the mega caps. And when I say worse odds, I'm not saying they're going to go down tomorrow. I'm just saying on a probability adjusted basis, they make less sense to me. And it's harder to see strongly positive returns. Certainly not saying that's impossible, but it's harder to see strongly positive or at least very high returns. And then there's other areas where I think have better odds, and in particular it's those kind of multi-bagger names, and particularly in the mid-cap growth space. I think China's interesting, and then some of your classic compounders, your kind of boring quality names. And so I'm going to give one or two examples, and that's more of an emerging area. It's not, I wouldn't say it's totally widespread just yet. So what this chart shows, it's the ratio of the NASDAQ 100 index relative to the Russell 2000 small cap index. So it's just one divided by the other. And you can see that if you go to the left of the chart, the NASDAQ went parabolic relative to the Russell 2000 back in the tech bubble, and then it gave it all back, sort of bottomed out between 2002, 2007, and then, as you know, tech has had a really fantastic 20-odd years. So the Nasdaq is mostly tech. There are other things in there, but tech is the big component. And what I notice, I am more what I tend to like is the period between, say, if you look between 2007 and early 2020, like a nice smooth uptrend. When you get these parabolic moves that go vertical, it's like, if you think of like a plane that goes straight up, it's just hard for the plane to kind of keep that rate of ascent. Inevitably, it kind of stalls out and usually rolls over. Like, could it go go vertical and then sort of flatline? I suppose it is possible, but typically what you get is, if you have the sharp move up, you typically get a sharp period of mean reversion down. So this chart just gives me some pause and suggests to me, well, from here, perhaps small caps are a better bet than the mega caps. And just what this chart shows is the forward PE ratio for Microsoft. So a PE ratio is just a measure of how cheap or expensive something is. It's the price to earnings. This is forward earnings. So what consensus, what the Wall Street analysts think earnings are going to be for Microsoft for the next 12 months, divided into the current price. And this is the ratio, that ratio over the last 5 years. So it's not helpful to just say, the PE multiple for a stock is X. Like, you need some context for that, because that stock might always have a high PE ratio. So the ratio in and of itself doesn't tell you anything. But it's quite useful to look at the stock relative to its own history. What have people been prepared to pay for Microsoft in the past? And so the PE ratio is this sort of purple line. And what we can see in this chart is it's approaching a level where it's 1 standard deviation expensive. So this series is often mean reverting. And so could it get more expensive? Could it go north of 32 times? Yeah, it has in the past, sure. But if you think of the total spectrum of probabilities, there's not much more juice to squeeze out of the orange in this case. So yeah, certainly not saying Microsoft is going to crash here, but I just think one's expectations need to be more realistic, if not muted. Apple is a similar story. Like, Apple is trading expensive versus its own history. Fantastic company, one of the best companies in the world, maybe the best company in the world, certainly the biggest company in the world. But again, it's expensive, and everything that's good about it is well known. And I think a lot of people have also crowded into Apple, into Microsoft, because it's big, it's safe, it's got some growth, and if you're a fund manager, you'll never get fired for owning Apple. And so, and there's also passive vehicles and quantitative strategies, strategies that are not run by humans that are also buying these things. But again, from here, it's hard to see really high returns. And then finally, I think what is the poster child of I don't want to use craze at the moment, but it's sort of the hype cycle in AI is NVIDIA. And NVIDIA is a fantastic company. And actually, the reason why that purple line has come down lately, it's not because the stock has gone down. The stock has actually gone up a lot, but the analysts' earnings estimates have gone up. So it's brought down the PE ratio a bit. But it's another one where, yes, there's certainly a bright future in has been baked in, and I'm just not. It would be very difficult for, like, the fund doesn't own NVIDIA. Unfortunately, I wish we had. But you know, pulling the trigger now is a totally different story, and I just don't love those odds. So I think you've got an emerging picture with the mega cap names where they are trading rich relative to history. A lot of people have crowded in. You look at the ratio of the Nasdaq relative to small caps. To me, it just says that the opportunity is not in these names, or it's unlikely to be in these names. This is a similar-ish kind of chart to what I showed with the Nasdaq 100. This is just the yellow line, so that the white line is the Russell 2000. The yellow line is the Russell 2000 relative to the S&P 500. And again, it's trading at, you know, roughly at ratio lows relative to the last 5 years. And I would be surprised if that yellow line goes a lot lower. I would bet that line goes higher, and that the smaller companies outperform the larger companies. So as I've said, I think there's an opportunity in when I say smaller companies, it can be mid caps, just anything below the mega cap names, and particularly in the mid cap growth space. So one way that I kind of assess that is by looking at the ARK ETF. That's the ETF run by Kathy Woods, which is really focused on innovation and technology companies. And her ETF is, you know, it was the poster child for the, I guess, the post-COVID or the COVID bubble. But to the extent that there was a bubble, that is completely unwound. The bubble is completely deflated. There really is nothing left. And so what you're starting to see is the wheat being separated from the chaff, and the better companies are starting to emerge from the wreckage once again. So one example from the fund is a company called C. So I started buying the company back in the second quarter of 2019. The stock was a massive winner for us. It went up. It was roughly it was a 10 bagger at one stage. So we made like 1,000% return. We added and sold at various points between 2019 and 2021. But by where you see that red arrow is we'd exited most of the position by then. And then we watched it fall and fall and fall. And just to recap, C is an e-commerce company and an e-commerce and gaming company and fintech in Southeast Asia. And then it's got a growing presence in Latin America. But I think it's on the way. It's already the leading economic e-commerce player in Indonesia and other markets. And bear in mind, Indonesia's got 270 million people. So these are massive countries. I think it's on its way to just cementing its dominance in that region. But if you cast your eyes to the right, I started buying, bought back into C at the green arrow. I trimmed a little bit recently just to pull away where the dotted or the dashed red arrow is, just to bring it in line with some other positions. But again, like I'm actually planning, I'd like to add to it again over the coming weeks and months. But to the extent that there was excessive optimism, that's being completely washed out. C is still going from strength to strength. I still think it can be a multi-bagger from here. So I'm very bullish on C's future. What this chart shows is is earnings estimates for 2023 and 2024, and what the story was for a lot of these in 2020, 2021. The story for these companies, because there was abundant liquidity, the story was all about gaining market share, going out and often, running at a loss and just investing in the business, grabbing customers, opening new markets, and it's essentially kind of a growth at all costs. That psychology has really changed dramatically, and a lot of companies have found religion with respect to costs. So they've really said, okay, that era is done. The era of free and cheap money is over. Like, how do we focus on efficiencies, and how can we internally fund our growth? So what you can see is, if you look at the chart, what the red arrow shows is the analysts were downgrading their earnings estimates for 2023 and 2024. And then as the company has implemented cost cuts, those estimates are rising quite rapidly. And C's become a lot more focused on generating free cash flow. And typically, one thing that I've observed over my career is that stock prices tend to follow in the direction of earnings revisions. So as people take their numbers down, the share price tends to go down. And then as people take their numbers up, the share price tends to go up. So I think using C as an example, but I think there's other names where I think we can be quite bullish about the future of some of these companies that were really I won't say left for dead, but fell dramatically from their peak in 2021. The next area that really stands out for me is China. Now, I'm not a secular China bull. I'm more biased towards the US and their economic model. I'm probably sort of I would say I'm reasonably cautious on China long term. I'm not I don't see them becoming the dominant player in the world. All of that said, there's an opportunity set in China where I think the names are really, really cheap. And here I've got the example of 3 e-commerce players from China, Alibaba, JD.com, and a company called Pinduoduo. And they are trading roughly at 1/3 or less the multiple of Amazon in the US. And I'm actually quite bullish on Amazon. I think Amazon can still do well from here. But I think these names, if you think of them more from a risk-reward perspective, if they don't work out, I don't think they fall that much. Whereas if anything goes right, even marginally right for these companies, given where sentiment is, I think they can go up a lot. I think they could double in the next 18 to 24 months. You just need perhaps a reacceleration in the economy, maybe some stimulus measures from policymakers, or even if you're just seeing a sequential acceleration in their revenues. And these companies are also doing a lot to unlock, to reduce their costs and restructure their organizations in order to unlock value for shareholders. So, just to reiterate, I'm not a one-eyed China bull, but I think there is just a compelling opportunity here from a risk reward perspective. And this chart from Bank of America illustrates something kind of similar to that NASDAQ relative to Russell 2000 chart I showed you earlier. This is just the NASDAQ index relative to the Hong Kong tech index. And what you've seen in the past is where this ratio goes parabolic, it tends to then mean revert quite sharply. So if it mean reverted, if we expect to see some mean reversion next, what does that mean? It means that the Chinese names are set to materially outperform the US tech names. Then the final category, which I think is more of an emerging category at this stage, is what I said were those kind of boring quality names that are actually quite cheap versus history. So one example which the fund has fairly recently bought into is Heineken. So I don't need to explain what Heineken is, but I think what's interesting about this opportunity is you can, and these similar opportunities, and another one is a company called Waters, which does liquid chromatography. So it's got these machines which are used in chemical and compound testing in food sciences, pharma, life sciences. But the opportunity set is, if you've got these names that are being sold off, maybe because they're not NVIDIA, like people don't want to own Heineken, they just want to own NVIDIA. What does that mean? It means you can buy into really safe, steady Eddie companies and get a really nice return out of them over the next couple of years with relatively low volatility. To me, that's set up from a kind of a adjusted perspective, and even in terms of absolute returns, I think is compelling. So well, let's talk about how the fund has evolved and then how it's positioned. So yeah, so the fund had won multiple raging bulls and performance was strong, but more recently the performance has really struggled. And what I would say is, I mean, putting aside that my family is the largest shareholder, I'm just a competitive person, and it's been an immensely frustrating period for me. So I can understand if clients are frustrated, but yeah, nobody is more frustrated than I am. So coming into the year, I think like everyone else, I was, there was this macro picture which was quite concerning, and you just really felt like things were, I guess, kind of on the edge. And we were all talking about recession and inflation problem, et cetera. And so the fund came into the year too defensively positioned. I realized that, and then increased the exposure to the mid-cap growth space. And some of my timing for both of those things was in retrospect quite poor. And then the fund, what also hurt relative returns is this year has really been characterized by very concentrated leadership, particularly in those mega cap names, which you can see in the chart to the right. What that chart just captures is some of the mega caps as a percentage of the overall S&P 500. But as their proportion of the S&P 500 has increased, that's an indirect way of saying that they've really driven a lot of performance this year. And why didn't I own all of them? I mean, I've got Alphabet, which is Google, and then Amazon, which I bought. I bought both of those later in the year and done pretty well out of them. Why did I not hold them? Well, it's always, you just think other things are more interesting. And so it's, if we could go back in time and hold them, then absolutely I would have. Like, if I knew NVIDIA was going to go up so much, I definitely would have bought it. But I didn't know that. So the fund is not trying to look like the benchmark. It will be different from the benchmark. But that's a big reason why it's that underexposure to that mega cap theme, which is why the fund has lagged. And then again, some of my timing was poor in terms of holding defensives, and then that shift into the mid cap space. Well, what I would say is, ever since the fund launched, and this is an ongoing thing, I'm always learning from the trade history that I put through. I want to understand my biases. I want to see what does work, what doesn't work, and then use that to kind of tweak the fund's processes and algorithms, and just to do things and learn from them and do things better. So I'm always looking to build on the strengths and then mitigate weaknesses. And so the fund is kind of like so I'm always learning and evolving and improving. I'm a better investor than I was 10 years ago or 5 years ago, or even a year ago, because of this process. So the fund, like, I evolve and the fund will evolve as a result of that. So notwithstanding the fact that I do say to people, look, you have to have a 5-year minimum horizon. I'm empathetic that the path in between, the path along the way, does matter to people, and it matters to me. Like, the fund has been more volatile than I would have liked, and so I'm working on ways to reduce that volatility prospectively, and so I can't. It's impossible to get rid of all volatility. So I say I'm aiming to at least partially smooth the ride and reduce drawdowns. Probably what that means is any single year return prospectively is not going to be as high as it was in 2020 when the fund was up roughly 91%. But what I think it will mean is that the compounded returns over time will be higher than they would have been otherwise, just by reducing some of the drawdowns and the volatility. That is at least my working thesis. So how is the fund positioning today? I'm not sure that there's anything too massive to call out, too noteworthy to call out from here. Apart from, you can see that China was roughly a 16% weight. at the end of May. I've spoken about energy in the past. That's just under an 8% weight. Yeah, I've still retained some exposure because the energy market, the IEA expects it to tighten it and move into deficit in the back half of this year and into next year. And that whole energy scarcity kind of story might come into play again. I'm not sure. And so I've maintained some exposure there. I don't see, as I've said, like the other areas that are more interesting to me medium term are the mid-cap growth, China, and then quote unquote boring quality. But energy is still interesting, and energy is a kind of a portfolio diversifier. It can often zag when the rest of the market zigs. So it's it can be helpful from a kind of a volatility perspective. This is the top 10 at the end of May. There may be a couple of names that you haven't heard of in there, that you haven't come across before, like say the Trade Desk or Adyen or DoorDash. I'm not sure if you will have heard of that, but there's quite a few names in there that I think those names in particular, a name like Mercado Libre, do have multi-bagger potential. I've still got excuse me, exposure to Tesla. Tesla, I'm bullish on long term. They've been cutting prices, and I think that's definitely messing up margins at the moment. But to me, Tesla to me is just, I don't see how they don't win long term. I think Tesla is like to the electric vehicle market, I think is Apple, and maybe BYD from China is the Samsung. But to me, like they are the clear kind of leader. And then within the top 10, there's also two Chinese names, PDD Holdings and Alibaba. Just worth calling out a few interesting names from the top 10. And then just to summarize, so positioning and sentiment is pretty pessimistic. It might be improving on the margin as the market goes up. But generally, and I want to see how the next Bank of America survey comes out, and I'm keeping a close eye on this. But until now, sentiment has been pretty much in the doldrums, and people are positioned for that negative outcome, and so that reduces your risk to the outside, and to the extent that you don't get these negative events like a recession, that means that there's room for the market to run on the upside. The one more recent caveat is that you are seeing crowding in some of the mega cap names and in the Nasdaq and in tech. So yeah, I don't think those are the areas to be in. I think I like the mid cap growth space. I think China's interesting from a risk reward perspective, and then there's this emerging opportunity in boring and kind of safe companies, which I really like. If you don't have to take a lot of risk and you can get reasonable returns, that is, for me, is the best of all worlds. As I've said, the fund, I continue to evolve. The fund continues to evolve based on data analysis, research, and all kinds of learning. And as a result of that, my aim over the medium term, and I'm already implementing it, but I'm doing it in a measured way, not in a just shift the whole fund overnight kind of way. The aim is to reduce the fund's volatility. And then again, my long-term goal is for the fund to be in the top decile over the next 10 years. And as I said, like if I can keep doing that, then the fund's since inception returns will be in the top, say 0.5, 0.1%, or top 0.5 to 1% of a peer group, and that would be very pleasing to me. And so that's it from me, Derek. And so I think we can open it up to questions if people do have questions.
Thank you, Nick. I appreciate your time going through the details. So yeah, again, just cognizant of time, I think let's open it up to questions. Obviously, we'll just try and manage and make sure as many questions are answered. So over to you guys if you've got any questions. And remember, if you're going to be asking a question, if you don't mind unmuting yourself.
And don't be shy if I haven't if don't be shy if some of the stuff doesn't make sense to you if you're not like a finance person. I try to pitch it at a understandable level, but if I haven't done that, you know, don't worry about asking what you think is a overly simplistic question.
Nick, I'm happy just to ask one question from the outset, and just really wanted to touch on a theme that I can see as a portfolio manager playing out through the course of the last month in particular. Just obviously, as we finish the end of May, what we saw is quite a strong performance, as you mentioned through the presentation, in the NASDAQ, which came at the expense, for example, at the S&P and the Dow. So my question really pivots around the breadth of the market at the moment. In terms of, it's really just a handful of names that are really pushing markets higher, particularly from a US perspective, and that's obviously come at the expense of emerging markets at the moment. Perhaps you can just touch on how those big weight names are able to really move that market in a meaningful way, particularly from a NASDAQ perspective.
So it's just the way that the index is composed, and I think it's also, I think there's two elements where there's humans making decisions and when there's machines making decisions. And so if people buy sort of passive products, and if like a NASDAQ or the Apple is in multiple different ETFs, it's just going to get a lot of flow. And that's what happens for those sort of tech megaweights. And then also what some hedge funds will do is they don't need to buy every stock in the S&P 500 to get exposure. They might just say, well, this AI theme is hot, buy NVIDIA. Or, you know, Microsoft is a safe way to play this AI theme. To get in the cloud, we just buy Microsoft. Or Apple is safe as houses. Like, you know, it's liquid. I can just get exposure to the market, just buy Apple. And then you've got machines that would also, you know, sort of put together baskets of these things and then trade on other kind of correlations. So it's really driven by liquidity and money flows, and then it can be money flowing out of these other things and into that bucket. Now that's in the shorter term, you can get these like there's two major forces in markets. There's momentum or trend, and there's mean reversion, and they're often in conflict with each other, and they sort of fight. But that's always what's at play. And if you get a period of like strong momentum, then eventually what happens is mean reversion, and so it's like and you get these kind of momentum crashes. So these things that are very, very strong, suddenly they reach a point where, like I said, with that plane that just keeps on going vertical, it can't keep doing that, and then eventually some air comes out of that, and then the pendulum swings again. So where are we in that process? Like it's impossible to say, but as that continues, it just gets more. It gets riskier. It's like you keep pouring sand onto a pile of sand, and then eventually it sort of topples over. Like, it's maybe a bad analogy, but you say what I'm seeing. Like, you see what I'm saying. It's the situation kind of eventually becomes unbalanced.
Hi, Nick.
Yes.
Hi, how are you?
All right, and you?
Good. I just want to ask you a question. In my particular instance, I'm down about 24% from the level that I got into the fund. So I need to recover about 24% to break even. You talk about drawbacks. Is my timing just so bad that it's going to be very hard to see all these great ideas materialize when I'm so far down, or do you think there's still hope at these levels?
Look, so I obviously don't know the timing of which when you got in, and I'd say if you were, I guess, unlucky in terms of timing. And I can never tell people. I will never ever give guidance on performance because I don't know the future, and I know that people will just. The one time that I do it, people will say, "But you said," and I don't know. I can't see the future. I am quite I'm quite optimistic on the opportunity set. Like, so I would say theoretically, can the fund compound in the future to the point where at some time it recoups those losses? I think there are good odds of that happening, high odds. But I'll never guarantee that to you because this is not a structured product. So I am quite optimistic on the fund's future prospects from here, but I won't go so far as to sort of guarantee a number or say like you will like over whatever time frame. But the longer the time frame, I think it's that you look ahead prospectively, like yeah, like your odds improve dramatically the longer the longer your time frame. And I'm not saying that in a self-serving way. Like you might say, oh, you're just saying that, but like that's a kind of a generic statement to make. But I am bullish that, I think if some of these China names work out, I think there's tremendous potential. If some of these mid-cap names work out, I think there's still tremendous potential. And even these kind of boring safe companies, I think you can get a really nice return over the next couple of years. So I'm just framing it like that.
But what I'm saying is, if you say in the next 2 years, are you hoping to be one of the top funds again? Is that what you're aiming to be in the next 2 years?
Not in the next 2 years. Like I will let me say something to people on this. Like the Raging Bull Award has been, I would say, been both a blessing and a curse. Blessing, obviously, because it's nice to win an award. Why has it been a curse? It's been a curse in the sense that I think I've probably ended up pushing too hard or almost trying too hard, which I think has been kind of counterproductive. I do think I've got a good chance of being in the top decile over the next 10 years, but not the next 2 years. But like if people do have a 2-year horizon, this is just not the fund for them.
Okay, so, but what, in the next 5 years, do you think, well, what sort of return at these levels with the fund sitting at the moment can one expect in the next 5 years?
David, I cannot answer that. Like, I won't, because there's just too many variables. It's not knowable. Like there are structured products that kind of do that, and you should chat to Michael about that. Anybody who comes with an equity fund and says you should expect X is lying to you or lying to themselves, because we don't know. Like you can hypothesize. The markets can do anything. So like I'm not going to come and sort of, I'm not going to kind of knowingly, like I can come up with a number, but it's nonsense. Like I don't want to say it's nonsense, but it is kind of nonsense, So I know you're looking for some kind of comfort, but I wish I could give it to you. But it would be, I don't think it would help. I don't think I would be helping you by doing that. Or maybe I would. Like maybe if someone said like, you'll get X, and then that would help you to hang on until the end. But I just feel like it would be intellectually dishonest.
So maybe I should put new funds into it to try average out of that. I don't know. Maybe I'd be better off doing that if the fund is undervalued at this point in time.
So look, yeah, what I would say to everyone on this call is these are the kind of questions that you need to have with Michael if you work with Michael and other financial advisors. That's one point. The second point is make sure that the fund is sized correctly within your overall as percentage-wise in your overall asset exposure, and in a way, and with the mix of other things that you hold, so that it doesn't. So that it makes sense in that context, which is not something that I can answer. You'll need to sit with Michael to get that right for you.
Oh, that's fair enough. Okay, thank you.
Cool.
Thanks, Nick. I just wanted to see if there's any other questions out there.
I thought I might get a question about AI, Derek.
It certainly has been the big theme of late.
It has, yeah.
Okay, guys, if there's no other questions, I'd like to just kind of close the conversation by kind of advocating that obviously each fund manager within the Anchor Capital stable has certainly got their own style and unique flair and element to them. These are obviously fund managers looking for opportunities, and each fund manager will certainly have their own edge, which would be suited to different types of markets. Obviously, as I said at the start of the call, we've been through a very tough time when it comes to equities, and we are obviously fighting this tide of high inflation and obviously high interest rates at the moment. As we all know, that's a cycle, and cycles do turn. And hopefully once we start to see a plateauing of that and obviously a turn in equities, you're probably going to find some good and better performance in funds like this, which obviously focuses on growth. So certainly does look like some of the names that you mentioned within the presentation, Nick, have got some great potential, just given the prices that they're trading at the moment. But really, I think the most important thing about what we're going to do is just have a very engaging process. If any clients have got any questions or would like to engage with Nick as the fund manager, jot down some questions, send them through to Michael Saris. We've got a very open relationship with all the fund managers, and we can certainly make sure that any questions or any issues that you've got are certainly answered. So I think on that note, I'd just like to thank you, Nick, for your time. And thank you all the clients for joining today. I appreciate all your time, and we look forward to engaging further. And as I said, if you've got any questions or any related queries, you're more than welcome to reach out to Michael Saris in that regard. So thank you all. I hope you have a lovely day further.
Thanks, Derek. Thanks, everyone.